Want to know how Canada's top entrepreneurs think about creating significant wealth? Join me, Thane Stenner, founder of Stenner Wealth Partners at CG Wealth Management and host of the SmartWealth podcast. Download today at iHeartRadio or your favorite podcast platform. Subscribe now. Welcome, everybody. I'm Thane Stenner of Stenner Wealth Partners of CG Wealth Management. I'm the host of the BNN Bloomberg SmartWealth podcast, where I get to have the opportunity to host many of Canada's top pioneers, innovators, entrepreneurs, and executives. And one of those that I'm very pleased to have today is Mike Woollatt. Welcome, Mike.
Hey, thanks, Thane. Great to be here.
It's great to have you on. And I think the topic of private capital markets in Canada, which includes venture capital and private equity, and both in Canada and actually globally, is going to be a pretty interesting topic for our listeners here today. So I will go through a brief bio of Mike, who I've happened to known personally and professionally for roughly 5-6 years. And I've been very familiar with Hamilton Lane over the last 6-7 years from my time at Morgan Stanley in California, and now here at CG Wealth. So a little bit about Mike. Mike Woollatt is the managing director and head of Canada for Hamilton Lane, which is a global organization that he's heading up the Canadian subsidiary of. Prior to joining Hamilton Lane in 2019, Mike was a director of OMERS Pension Plan in the venture capital and growth equity groups. Prior to that, Mike was the CEO of the Canadian Venture Capital and Private Equity Association, which basically represents the stakeholders and constituents of the VC and PE groups here in Canada. So he's very plugged in. Very networked, and again, will be, I think, quite insightful for everybody today. He's also co-founded a management consulting firm and has held senior executive roles at a few major Canadian companies. So prior to getting into the private sector, Mike also worked with the government of Canada, first as a research economist, and then as a political and policy advisor to the Minister of Finance. So a very senior consultative role. Which would have given him some very good insights as to what was going on the Canadian landscape and global landscape. He's also worked overseas as an economist on World Bank funded international development projects, and he's even taught economics at the university level. Mike is a frequent commentator on both broadcast and print media on the state of the Canadian private capital markets. I'm very pleased to have him here today. And lastly, he holds a master's in economics from the University of British Columbia, our neck of the woods here in Vancouver, but he currently resides in Toronto. Mike, how long have you lived in Toronto now?
Oh, I've been here since 2007, a West Coaster that moved out to Toronto thinking I'd be here a couple of years, and I got stuck. So, but I'm having a great time in Toronto. Geez, Thane, when you read that out, it's been a long road to get here. I feel like I forgot some of those things. Thanks for
They call it experience. They call it experience. Mike. You've had a varied background, but I can tell you that from a lot of the people that I see in the industry, you're extremely well positioned on giving our viewers, I think, a current state of affairs on the current private capital market. So, with permission from you, is it okay if we jump into the questions?
Absolutely. Yeah, happy to take this any way you want.
Sounds good, Mike. So tell our listeners a little bit more information, for example, about Hamilton Lane's history and current market position. Let's just begin there.
Yeah, sure. Yeah, and private markets, especially even for a lot of your clients and a lot on the private wealth side, private markets are relatively newish in Canada. So it's nice to take some time to explain who Hamilton Lane is. I've known Hamilton Lane for a number of years, but I'll tell you, when I came over from OMERS a little while ago, there's more than a few people that asked me, "Oh, you're moving to Hamilton?" No, nothing to do with Hamilton. Anyway, Hamilton Lane, been around for 30 plus years, started in 1991, really helping pension plans and endowment funds at the time access what was a pretty small private equity market, call it sub 100 funds. About 30 years ago, there was really not a huge market there, but helping to build what was a kind of a mystifying sector in this private equity. But so it started there. they were building portfolios and monitoring and reporting on these portfolios. And Hamilton Lane really started to lead the charge in terms of creating what are called separate managed accounts, effectively investing in other managers all over the world on behalf of these pension plans. That business has grown substantially. So we now work for some 800 plus pension plans, endowment funds all over the world, and building their portfolios for them. Hamilton Lane is Philadelphia based, but we have 21 offices around the world. We've now built the business to about $830+ billion of either assets under management or supervision. It makes us one of the largest pure private market allocators in the world. And I mean that, but pure private market, that's all we do. Hyper-focused in what is a relatively small, I guess, but growing asset class, substantially growing asset class in the financial markets. But we literally do focus on 3 different areas: private equity and its subcategories. So think venture capital, buyout, which is a lot larger than venture capital, growth equity, secondaries, and the like. But basically private equity, private credit, and private real assets. And so we don't spend time on, I don't handle questions on things like hedge funds or fixed income or public. We've always been hyper-focused in that one area. So we build portfolios for pension plans all over the world. About 20 years ago or so, we realized that footprint, that we are one of the largest investors out there. We put out some $37 billion into other managers all over the world on behalf of our clients around the world. That footprint gets us access to 2 things. Gets us access to deal flow. So in the private markets, a big driver of deal flow is co-investing, meaning if you are a big backer of a fund, they offer some of your largest investors co-investment on top of backing the fund. And so we get access to co-investment deal flow set, and also get access, importantly, to data. And we'll probably talk about that later, but as I'll probably say a couple of times, there's no Bloomberg terminal for private markets. There's no place to go and find private companies and enter in a code and seeing what it's trading at. Yep. And so data, it's private. That's the name of it. So data is key, and data allows you to make better decisions and allows you to act quicker in a market where speed and certainty of capital is something that is key. So we have one of the largest databases in the world, and some 50,000 funds. We track $13 trillion in fund commitments, like 130,000 plus private companies we're tracking on a cash basis out there. So in the majority of the private markets we have access to because of our footprint. So all of those combined, about 20 years ago, we raised a series of commingled closed-end funds to take advantage of that deal flow in different ways. Co-investment equity, co-investment credit, secondaries, which we can talk about as well, and have built that footprint. Those funds, most of those funds are on, call it vintage, 6, 7, 8, depends on and they do very well, and we raise them here in Canada as well. And then about 4 years ago or so, we started leading the charge in providing a fund that is a little bit more open-ended, which we can talk about, that provides high net worth family offices and the like, accredited investors, access to private markets without sort of the headaches of private markets, if you will. But with that, I'll stop, and I'm happy to continue. But yeah, Hamilton Lane is the largest name that very few had heard of until we started really building a presence here a few years ago and established an office here in Toronto, and continue to scale here, which is exciting.
Yeah, it's very exciting, and reputationally, I've known the group for 7, 8 years now, and I've been very impressed with just the leading edge and kind of the innovation, even on some of the structuring for wealthy investors and for family offices. So I could see that play out. So how would you describe Hamilton Lane's investment philosophy at a high level?
Yeah, I sort of hinted at it in the beginning. Our investment philosophy generally is in terms of from a working process standpoint, we leverage our size and scale substantially globally. And so we raise very diversified funds all over the world that gain access to and invest alongside top quality managers sort of globally. So our size and scale is key. And then our hyper focus in the private markets allow our various teams work together seamlessly. They're constantly, so very collaborative type of approach. And what I mean by that is we have folks that invest. We have a huge team that invests in funds all over the world. We have a big team that does co-investment. They're constantly talking because they're all in the same sector. And so the ability to collaborate across the firm is sort of second to none as a result. In terms of our overall philosophy in building portfolios, we focus on risk return, which where a lot of the private markets focus on. You're looking for lower volatility and higher outperformance versus vis-a-vis the publics. You'll see us build diversified portfolios in our funds, particularly that provide Canadians or others access to a pretty diversified portfolios globally, which is something we're known. And then in terms of a focus for groups that ask what I often get asked what our focus is, I think we're best known in the mid-market space, small mid-market buyout space. We're US based, as I mentioned, totally global, but where we spend much of our time is on the small mid buyout, while we do invest in growth equity and the like. That's where we spend most of our time. And then we've taken that kind of institutional approach, if you will, that we've been doing for 30 years, and bringing it to the private wealth side, and allowing access there. So yeah.
Yeah. So as far as track record, since inception, obviously there's been various vintages, but kind of what's been the overall average of the various pools of capital since inception?
Yeah, so it really depends. I mean, it depends on if you're talking about the buyout side or the credit side or the real asset side. But we typically target on the buyout side sort of mid to high teens in terms of net returns but that's our overall target. In terms of our evergreen fund, which is most applicable probably to your listeners, our since inception track record sits around 17% net returns. So we're sort of doing what we said it would do in Canadian dollars, and USD is sort of mid-teens, if you will, 15% ish since inception as of, what is it, November 30th? I'm looking at a little chart here, but as of about November 30th, there's always a bit of a lag in reporting, right?
Of course.
Yeah.
So who would you say your top 2 or 3 competitors are globally in your space?
Yeah, so it depends on the more retail side. These evergreen open-ended funds that we bring to market and for the wealth platforms. There's a few local Canadian players, groups like a Kensington, if you will, as well as some others, and then globally groups like Partners Group and some of the others. On the asset management side, think groups like Harbor Best, Northleaf here locally, and Neuberger Berman, Stepstone, groups that build portfolios and then take access of that or take advantage of that access that they get by building portfolios.
Okay, we're just going to take a pause there, and we'll be right back. Thanks, everybody. Want to know how Canada's top entrepreneurs think about creating significant wealth? Join me, Thane Stenner, founder of Stenner Wealth Partners at CG Wealth Management and host of the SmartWealth podcast. Download today at iHeartRadio or your favorite podcast platform. Subscribe now. Welcome back, everybody. My guest today is Mike Woollatt, and after the break, I think we're ready to kind of get into some more questions. So you joined the organization back in 2019. I shared with everybody kind of a brief bio on you. So how did that come about? How did you join, and why did you join?
I've been the CEO of the Canadian Venture Capital Private Equity Association for years. I got to know Hamilton Lane pretty well because a big part of my job was trying to attract large institutional quality, we call it, private equity to Canada. Trying to encourage more investment in Canadian technology, buyout, whatever. At a time when a lot of Canadian companies were a little more starved, I suppose, for capital. So I got to know Hamilton Lane over a number of years. Really respected them, liked them, know the team. Just on a personal note, I can tell you, Hamilton Lane it's a fantastic. It keeps winning best place to work in private equity every year after year, and a lot of what I like to say about it is it's sort of deliberately not New York private equity. No offense to the New York private equity firms. I know lots of them, and they're great. They're great folks, but it does have a sort of we take our jobs very seriously, but not ourselves as serious. And it sort of fits with maybe it's more Canadian, if you will, even though it's US, it's more of a Canadian type of approach. But it's a wonderful place to work, and obviously I got to know the folks there quite well. So I was at Omer's not for too long, actually, working with your previous guest, actually, John Ruffalo, at Omer's on the private equity side. But I thought, boy, really what came about was I started talking to them, and I thought, man, if we can bring this sort of size, scale, sophistication on the private markets that Hamilton Lane brings, and we can bring it to Canadians in a much more sort of persistent fashion, if you will, in terms of opening an office and really getting to know the investors, whether they be institutional or on the wealth side. Boy, if we could do that, there is a real opportunity here to provide Canadians access to like globally diversified portfolios at sort of world-class private equity, if you will. And so I sort of knew it would work. And so we opened the office here in 2019 and really started going, and the team continues to scale. In fact, we're looking for new office space if anyone's listening. And I'm kind of happy to say that vacancy rates are up in Toronto, so we're looking for larger space and building the team out as we continue to build both on the institutional side. We have a number of clients here in Canada that are terrific to us, and then as well on the wealth side, as I mentioned, we continue to see tremendous interest in the private markets, particularly on the wealth side, where Canadians tend to be a little bit behind, I think it's safe to say, in terms of accessing private equity and private credit. And so we're sort of leading the charge there, if you will.
Yeah, and I would definitely concur with you on that. From my 4 years down in the US, the Morgan Stanley, and seeing their alternative platform and whatnot down there, seeing the exposures versus what Canadian investors typically are doing. So I think we're playing catch up, but I think when some global players like Hamilton Lane come into the market, of which you're spearheading, it's a very good sign. I think it's a very good opportunity for people to really get educated, and to learn more, and to increase their exposure. I think one survey I saw on the Canadian wealth side of things was that only 3% of Canadian wealth clients had any type of alternatives within the portfolio, which kind of shocking. And it's higher in the US. I think it's probably around 10-12% there, the last numbers I saw. But it's you're definitely in a growth segment long term, I think, for sure. And I'm a big fan of that. So
I think just generally the private markets is a terrific place to invest for a number of reasons that the Canadian pension plans figured out a long time ago. And they're, quite sophisticated, really globally known, especially the large folks, sort of the top 10 are globally known in the private markets. And you think to yourself, well, if the pension plans are figuring this out, where's the rest of the capital? If your pension's growing with it, why shouldn't we? And the attractiveness of the private markets, and the reason I is still going to continue to scale. There's no crystal ball there, but the private markets is likely to continue to scale and grow as a percentage of most folks' allocation. We have some, for instance, institutions, we're talking half of their portfolios moving towards the alternatives. And so the Canadian, high net worth credit investors are catching up. But it's in fact, the private markets have outperformed the publics 20 of the last 20 years in a row. It's public market equivalent anyway. Private credit, that's 19 of 20. And that outperformance isn't just the only reason, but that outperformance makes it quite attractive. And it outperforms really for sort of three reasons. that make it attractive for folks to invest. It outperforms because it is, especially in certain sectors, there is an information advantage that some players have, as I already said, in terms of what you see out in the private markets and information in the private markets. Those that have information can outperform. You think about it as an inefficient marketplace.
So put another
Yeah.
way though. In essence, you're not having to deal with insider trading rules. Like no, but candidly, that's true, right?
Yep.
Is these are private companies, private valuations. You're picking up smartly, data points, discussions through the companies, competitors, etc. At the end of the day, you're not restricted by that. So that's that information advantage is a real advantage.
Yeah, that's certain groups can take advantage of what is effectively an inefficient market, right? From that standpoint versus what you see in the public. But really, it boils down to the opportunity set in the private markets just dwarfs what we see in the public. 90% of companies with over $100 million of revenue or more are private. And you take said another way, 95,000. There's 95,000 private companies with annual revenue of $100 million or more. There's 10,000 publics. And so not all of those companies, want to be bought by private equity. Let's be real here. But the opportunity set is still larger, substantially larger. It's got to be. Yet private markets still raise in a given year roughly 2% of the world's MSCI. And so it's still relatively small compared to the opportunity set you see out there. As well, if you think about going forward, number of listed public companies is declining, as everybody knows, and it's concentrating. And so the investable universe on the private side is larger. That helps some of the outperformance. And that value creation shift from public to private is illustrated by a few interesting examples like Amazon, 10x private return, pretty famous, decent return, but about 2000x on once it went public, versus Google, Facebook, Alibaba, all these companies in technology, yes, but most of the returns are generated on the private side. Gotcha. And then the last reason privates outperform is, and some folks might disagree with me here, but we'll say it anyway, it's a better governance model to outperform. In the buyout world, the investor owns the asset, and the investor, the buyout firm, whatever it is, has much more levers that they can pull than you can on the public side. You can merge the company, you can find some cost savings. The board is made up of the owners of the company, and so the alignment there is perfect, I guess you'd say, from that standpoint. So that better governance model also allows for some outperformance. Long way of saying that privates have outperformed over a long period of time. So it's an attractive asset class to invest in, obviously, as it has outperformed, but also it's relatively smoother ride on the way through.
Yeah. So you touched upon a really good point, which I'm sure we'll have some comments on. So you don't have the mark to market, right? There's more of a smoothing process on the prices. I'm going to bring up because I know how knowledgeable you are. I'm going to bring up a point around, some current chatter in the marketplace, given the fact that we're January 23rd, 2023, and we're 1 year into a bear market. Market's down 20 to 33%. Whether it's rallying a little bit, obviously this year, but in the public markets, in the private markets, you guys are marking quarter to quarter, and the ride tends to be because of that a lot smoother. The criticism of that, and I'm sure you'll have a comment here, is around, well, is it mark to market or is it mark to reality or not, right? So there's lots of debate, I think, going on right now around saying, well, in the VC space, there's a lot of VCs probably that are still going to be marking down some of their portfolios here this year as a lag effect from the technology markets kind of selling off like they have the last 15 months or so. So a commentary on that?
Yeah, I get that question constantly, especially in a volatile market. And some folks that aren't investing in private equity will say, "I told you so." They're just making up the valuations. And so I'm very used to the question. Get it? Basically, I got to say, probably every meeting right now. So there's a few things. To unpack there. The first is, if you take public markets are off and privates aren't. The run up was a lot less in the privates as well. So the multiples that privates ended up paying at the peak were significantly less than the publics were valued at. So effectively, they had less to fall. If you take the sort of a standard distribution of returns, effectively, public was way out over its skis, using a Canadian term, way out over its skis versus private. So if you're a believer in a reversion to mean in returns, effectively the public had further to come down. So that's an important point. The other important point to remember is, and it depends on the fund, and it depends on obviously what you're looking at. But if I look at our fund particularly, returns on the private side are still, the revenue's still double digits, EBITDA is still double digits, margins are still holding up. And so when you mark to market, yes, multiples are contracting. As you look at the public market equivalents, you should expect multiples to flatten or contract a bit, particularly as interest rates rise. But the underlying performance is still really strong. And so the way privates tend to value is, yes, they're looking at public market equivalents, but like you said, they're looking at long-term potential and performance. Effectively, they're not moving on what Elon Musk tweeted last week.
Yeah.
Today. And so that's an inherent advantage. There's a bit of a lag there in the reporting from that standpoint that you can somewhat take advantage of. A good example being in March of 2020, when you saw the public do a big V effectively.
Yep.
And the privates just flipped over top of that as they had some opportunity. Now we have a little bit unique window into this. We do have a monthly valued fund that we're pulling forward valuations, and so we're constantly marking to the publics. And what you can generally expect in the privates versus the publics is, for the quant geeks out there, the beta is about 0.4. So it moves directionally somewhat with the publics, but a lot more muted. So call it a 40% correlation, roughly, if you take the whole private markets. And so as a result, you're just not going to see those massive swings that you do on the public side.
Yeah. So we'll come back around to your evergreen fund, because I think it's a really smart, brilliant structure. But before we get there, a lot of people are, maybe they've heard that being in private equity or venture capital, you should expect higher returns because there's an illiquidity premium.
Yeah.
Your evergreen fund is a unique structure, which again we'll get to shortly. But traditionally, one of the advantages that I've observed in practical sense with ultra high net worth clients, family offices, is that once you're in a traditional private equity or venture capital fund, you're in it for the long term, right? You're in it for 10, 12 years, kind of likely minimum. And there's a J curve and everything else. So the bad news is that, in that type of structure, you're not liquid. The good news in that type of structure is that you've got investors that can't panic out so easily. So, and candidly, during different bear markets, that's actually been a savings grace for some investors that they didn't appreciate necessarily at the time. But, as markets have, gone through bull and bear markets over time, the underlying portfolios have done exceptionally well. So I think maybe just comment about, the pros and cons of, from the investor's point of view, aside from the returns. I mean, obviously you're aiming for, mid-single digit to double digit returns 15 to 18%. But aside from that, what are some of the other structural benefits to, say, your evergreen fund?
Oh, sure. On the evergreen side, just on that closed-end fund side, if you will, you're right. Sometimes I suppose they can save people from making some poor decisions. A number of folks I talk to, I think, overvalue the liquidity that the publics have and undervalue, I suppose, the illiquidity that private equity and private credit and private real assets sort of command from that standpoint. And so these 10-year closed-end funds is very, as your listeners would know, is sort of a typical closed-end fund. What we did is, and others have done it, we're not alone here. It's just I do think we're sort of leading the charge here on the evergreen, open-ended, whatever you want to call it, side. Effectively, what we've managed to do is create an open-ended for credit investors only, importantly, but it's an open-ended evergreen structure that accesses private equity. So it doesn't have long-term lockups. That's one of them. There's a couple of headaches, a few headaches, quote unquote, with the investing in private markets, as you mentioned. One of them, 10-year lockup. The illiquidity there can be difficult for some. The other is, and you mentioned off the top, J curve, meaning capital is called before there's return from investors in these closed-end funds before there's actual returns. So there's a J curve. And then the other somewhat problem with building a private markets portfolio is ensuring you're able to build a diversified portfolio. And so if you think about it, if I want to build a broadly diversified portfolio, I should find a manager that does healthcare. We've got to get a technology. We've got to get industrials. We're building a portfolio like you would on the public side, right? We've got to get some US, European exposure, rest of the world. You get the point. You're sort of trying to build a portfolio, and that's a lot of managers to commit to. Now you've got all these underlying capital calls that are coming for these, and so all of that creates some headaches. And so we created a fund effectively that values monthly, where you can come in with about a 10-day lag into a fully diversified, fully baked private equity portfolio that allows folks with no sort of hard lockup from that standpoint. And so it allows folks a little bit more optionality as well. The J curve is busted because it's a baked-in portfolio. You're not calling capital. There's underlying assets that's in that fund, and they hopefully, if we do our job right, continue to grow. And so as a result, the J curve's gone, and so from that standpoint, we launched that fund 3 years ago. It continues to scale, and we're raising assets globally. And then the last thing about it, which is somewhat attractive, particularly on the Canadian side, is when you're talking to Canadian accredited investors, is it's building a globally diversified portfolio. So yes, there's some investments in Canada, but Thane, you probably run into this a lot when you look at Canadian portfolios. Yeah. Most folks tend to be a bit over-indexed to Canada. And so
home market bias, right?
Yeah, home market bias, exactly. So, you're accessing private markets for, as I already mentioned, the outperformance, but also the diversification away from your publics. And so bringing a portfolio to Canadians, accredited investor in Canadians that is sort of globally diversified is something that has proven to be, I think, really, really attractive. So yeah, it's great. It's nice to represent a brand name in Hamilton Lane in the high net worth space.
So I'm with special guest Mike Woollatt, Managing Director and Head of Hamilton Lane Canada. We're just going to go for a quick break now, so we'll be right back. Want to know how Canada's top entrepreneurs think about creating significant wealth? Join me, Thane Stenner, founder of Stenner Wealth Partners at CG Wealth Management and host of the SmartWealth podcast. Download today at iHeartRadio or your favorite podcast platform. Subscribe now. We're back with Mike Woollatt, Managing Director and Head of Hamilton Lane Canada. We're going to get right back into some questions. So bring us into the tent even deeper here. I'm curious, it's January 2023. Yeah. Interest rates have gone up dramatically over the last 18 months, particularly in 2023. Tech stocks have sold off. The home stocks sold off. The broader markets have sold off. Even the bond market's been, last year had a really, really bad year.
Mhm.
The in-house view, and this will probably play out in your evergreen fund, as to where's your organization seeing the best opportunities currently, and maybe just looking out the next 12 to 24 months, not from necessarily a return perspective necessarily, but more from, where will be the best opportunities, if not today, possibly during a recessionary period, if that happens here the next 12, 24 months.
Yeah, boy, a lot's happened in 12 months. If we had
Yep.
this conversation 12 months ago, or maybe 13 months ago, I guess, be quite a different one. Interest rates rising, inflation, Russia, China, recessions and the like. Generally the house view first, is we think, and actually one of your previous guests would agree with me, I know, and Mr. Rosenberg, in terms of the worst of the inflation is likely behind us. It seems like the Fed and the Bank of Canada, for that matter, have gotten a hold of that. Rates should remain elevated for a period of time. Now, remember, we're still well below historical averages here. If you look at the Fed rate going back over time, we're sort of in 2005 to 9 land, but below historical averages on the interest rate side. Private markets are going to continue to rise just generally, as I've already said, now and into the future. What we think over the next little while, volatility will likely persist. It's likely a stock pickers game, including on the private side. There is a substantial amount right now, particularly on the private side, of bid-ask spread, if you will, on assets.
Yep.
And some of that's pretty natural. If you think about it, if I'm on a board of a private company, and Hamilton Lane comes along and offers me a value of, call it 30% less than it was in January. It's going to take a couple quarters of audited reports on a new valuation, a new, structure, if you will, to accept that offer. Whether I'm, I own the company or I'm on the board or whatever. So there's a natural slowdown that's happening. Where we see opportunities. Just finish on the slowdown. I think, we think there's a mild recession likely. We're probably already in it in the US, or already in it in the US, where most of the private markets are. Europe's going to have a little bit tougher time. Inflation really grabbing a hold there. UK is particularly going to struggle right now, given a Brexit and the like. And take the politics aside, just look at the economics of that. But also, obviously, what's happening with Russia and energy prices and the like. So, a bit of a dark winter there. But as I look at the opportunity set, where we see opportunities is still and this is where private markets, we love to play in it, in terms of sectors and thinking long term. Technology still has to drive a significant amount of long term change. We're at the beginning ends of some of it, if you look at what's happening with AI and the like, but really where we spend most of our time is in the buyout side, and think mission critical software is going to continue to grab a bigger and bigger percentage of the economy. So we tend to look at information technology as a big sector, particularly industrials generally are quite attractive right now as prices have come off a little bit. It's a little bit of there's some value plays in there, but particularly think over medium to long term, that's going to continue to grow. And then healthcare has a ton of tailwinds, as we know, with the demographic shift. And so those are, and then when you dive deep into those sectors, what do we look for? We look for market leaders in each of those industries. Think positions 1, 2, and 3 on the private side, at least, that have the ability, particularly now, but just always, have the ability to pass on price inflation, and that power that comes with being a leader allows some of that. And so those are sort of 3 sectors we are particularly bullish on. In general, if you're looking at geographies, US is where we're spending a lot of our time. Western Europe a little bit less, but still there, as we see a bit of a softer landing, as I already said, in the US.
What about Asia?
Asia, very interesting. It's still relatively small on the private market side, right? But there is lots of opportunity there. We're a little wary of China and things happening there, sort of short term, so we're treading lightly there, but there's still lots of opportunity there for sure. It's still about, call it 10% of the total private markets, right? As a relatively small as private markets are mostly developed world and scaling, but it's still, call it rough numbers, but if you take the total NAV, you're sort of 2/3 US, North America, 20 odd percent Europe, and then Asia makes up most of the rest, Middle East, Asia.
Gotcha. Yeah, it kind of reminds me of a conversation I was actually having today with a fellow out of Toronto, and he sold his high tech business last year, pretty fortunately in Q1. And so, we were discussing kind of how to deploy a couple $100 million worth of proceeds. And it was interesting because I asked him, I says, were you happy with your sale price? And he says, yes. I said, but he says, I probably left some on the table because of what was going on in his life at the time. I said, well, let me put it to you another way. Would you have bought your company for the value you were paid? Is absolutely not. So he was pretty happy with the diversification, and this is a pretty seasoned veteran in the tech space, 30 plus years, and he said, but he goes, there's going to be opportunities again. There's always opportunities to invest in technology, because at the end of the day, technology is able to scale businesses, right, and scale opportunity sets. So, but he did. It was quite interesting because I think, he goes, yeah, I think there's going to be a really strong buy in tech, both private and public, in the next 12 to 24 months. So he wasn't bullish right now. He was kind of saying, I think it'll correct some more possibly, which is consistent with, I think, with what you're saying. But it was quite fascinating. I also went on to, have a conversation with him. He says, yeah, the challenge for entrepreneurs that are selling businesses these days, just coming out of COVID, is, do they have the energy to still kind of take it to the next level? Are they willing to, take a haircut or price reduction from maybe what some of their peak values were, 12, 18 months ago? So it was a really candid conversation. But what I also kind of warned them about was, when you tend to sell high, just thinking from a seller's point of view here, when you tend to sell high on a private equity business, a lot of times these entrepreneurs they're in a rush to deploy the capital right away again. So they want to put the money to work. And this conversation, which I've had many, hundreds of times in my career, is basically I was saying to him, look, if you sell high a business, you got to be very careful about buying high in the public markets, right? When you deploy, right? Because cycle, tends to be amplified, like you were talking about. And in his case, I think your points about public markets got way ahead out on their skis on valuations, and he happened to be a beneficiary of selling. But he says, yeah, everybody's telling me to deploy right away back into the public markets. And so he says, I like your approach about, slow playing it and gradually deploying, maybe over 24 months kind of thing, simply to, try to take advantage of some of the public markets. But your comments, Mike, I think are really spot on. So I think just to kind of wrap up the interview, I'd like to ask you one more question. You've had a bird seat view of the industry overall from various roles and positions. So maybe just give our viewers and listeners kind of, what are some of the 2 or 3 things that you've learned? Like if you're, if the organization is doing due diligence on a manager or like, what have you personally learned that you'd like to still share with our viewers and listeners today?
It's fine. Yeah, it's a great question. one nice thing about being the vantage point of Hamilton Lane is sort of seeing the entire market, given our
Yep.
size and scales I mentioned. And so you sort of, I see the gamut of investors. The one, I suppose if I had a lesson learned and you look back over, our history in Hamilton Lane and take a look at the data, there's two things on the private side that, or at least just generally, that folks, I guess you have to either watch for or you can take advantage of. The first is there's a number of groups that try and sort of time the markets, if you will. There's often a tendency, particularly on the private side, to, oh geez, there's a, let's slow down, allocation. Let's not do this vintage year or whatever it is, because we're over allocated, or boy, it's really scary time to invest, and the like. That's probably the time to invest. Trying to time particularly on the private side, and you look back over time, the underlying pension plans, endowment funds that perform the worst are the ones that turn off and on their allocation as they're building their portfolios. And it's pretty classic, but there's some fun data that proves it out. You just have to go back over time, and you can see like the outperformance we always talk about, the outperformance in private side versus the public is there over, as I said, last 20 years of this public market equivalent. But that outperformance actually exacerbates in downturns, meaning that outperformance is larger when things are going, so I guess sideways, whatever you want to call it, in the public side. And the tendency is to let's dial back when actually it's the opposite. Continue to allocate. And then the other thing I can see, given my vantage point here, where if you look at overall returns and the like, it's and we've done this, and we're looking back on our own clients, is picking the right manager or whatever is really important, don't get me wrong, but getting the allocation correct in a portfolio is more important than picking winners. Avoid losers. That's a big one. But if you look back over time, it's getting the allocation right. So I think, by and large, what I've learned being here at Hamilton and looking at some of these most globally sophisticated investors as clients and the like, it's the ones that do the best. They don't time the markets, and they get their allocation right.
So they're consistent and they're allocating.
You got it. And the mix, most are sort of, at least at the large institution side, call it 20-30% into alternatives, and I said growing, and that allocation has led to I suppose an outperformance over the past 20 years. So I think that's what I see, and when I look at Canadians generally, and so obviously speaking more in generalities, but the allocation has some work to do, and I see a tendency with Canadians to think, let's try and find the perfect time. And as Mario, our CEO, had said, speaking up here in Toronto on Monday at a conference, but which I really liked. It's, hey, private markets have outperformed 22 of the last 22 years in a row. You want to guess this is not the year? Maybe you could get that a crack, but that's and try and wait or time it or whatever you want to say, but time in the market, as they always say,
Yeah, well, actually, and that applies to the Morningstar and Delbar investor surveys that are done each year on public markets. Public market investors over the last 30 years have averaged something like 5% a year average, when the underlying U.S. markets averaged, well, this is equity funds, has averaged around 9.5. So there's been an underperformance of around 4.5% per annum. That's because of buying high, selling low. And that's in the public market. So I think, again, the advantage of having, a private markets portfolio that you're kind of more invested in, and you kind of have to stay in more, is a major advantage in some ways, for sure. And your evergreen fund structure, I think, has solved for that. to a significant level, and hopefully people take a longer term approach with that as well, even though you're giving them a monthly liquidity.
Yeah, it's still, this asset class is still relatively illiquid, and it is still a long hold asset class.
Yep. Yeah.
And even on the evergreen closed end side, we usually say to our folks, think of this at least 3 to 5+ years. That's sort of, that's what we're targeting in terms of companies we're putting into that portfolio. So it still should be in terms of, time to exit. It's still a long hold. It's nice to not have to, be formally locked up for, 10+ years. Yeah.
Yeah. And I guess what I'm kind of thinking of is what's been going on with some of the large global real estate funds right now, and some of the credit funds that are being gated. So you've got a really smart, well thought through structure, I think, in the evergreen funds, which it doesn't surprise me you're gathering significant interest in assets into that. Well, Mike, I want to thank you for your time today. Again, I know you're a very busy fellow, but really appreciate you sharing your insights with our viewers. And so that's, again, thank you very much. Really appreciate your time.
Well, thanks, Thane. It's nice to be here, and amongst as well, it's a bit of an honor to be here amongst some esteemed other guests as well. So I appreciate that. Thanks.
Very welcome. So that was Mike Woollatt, MD and head of Hamilton Lane, Canada, discussing the current private capital markets in Canada and globally. So that's a wrap for today, January 23rd, 2023. I'm Thane Stenner, and thank you very much for attending. Our next guest will be John Medved, who's the founder and CEO of Our Crowd, a very respected VC-related portfolio manager based in Israel. He'll be actually a guest zooming in from Israel, which is kind of cool. I'm really looking forward to that. So please join us next month on the BNN Bloomberg SmartWealth podcast. Thank you.